Josh Rosner, nice to see you in the middle of a lake.
Thank you for having me in the middle of a lake.
We're here at Camp Kotok in Maine. So what's the next big problem that's going to blow up and impact the markets?
Well, there's a few that could become problems. And I think that there's a lot of macroeconomists who are missing some of the micro pieces. So we've got a very severe shortage of short-term collateral. I'm somewhat concerned that we could end up in a liquidity crisis sometime in the next probably year and a half, where there's just not enough repo collateral. As rates rise, I'm also concerned that everyone is expecting to see net interest margins at the banks improve, and I think that'll happen, but it'll be very fleeting. If you look at bank earnings, if you look at the call reports, all of the loan growth that we've seen is coming from some interesting, arguably bubble-like areas. So for the first time in history, we're about to see commercial and industrial loans outpace residential mortgage loans as a percentage of banks' books. And that's a little bit worrying, because if you think about it, what we've seen over the past several years is our healthiest companies, the Fortune 100, have record levels of cash on balance sheet. They have locked in very long-term, low-interest rate debt through the capital markets. By keeping rates so low so long, what we've done is we've stoked a new bubble. And that's in the less healthy companies being kept alive by low rates. The banks have been doing C&I loans. In fact, if you look, C&I volume has grown at your average bank more than 60% since 2011, with the average yield going from over 5 to under 3. And a lot of the loans that are sitting on bank balance sheets, besides being covenant light, really are shorter term. And while that'll give some opportunity for, as rates rising, some repricing, there's a lot of companies who are so saddled with debt, that's part of what we've seen in the leveraged lending market, that I think you're going to see some of those roll off. Some of them refi, but a lot of them also potentially default. So I think it's going to be a great environment for the distressed investor. That said, I also think, depending on the trajectory of the curve, you could end up in a liquidity crisis, and that actually would be terrible for some of the ETFs. And obviously some of the others. Now the banks, in that regard, are in pretty good shape. The Fed has pushed a lot of the exposures out into the shadow system, and while that's good, at the end of the day, those are also the counterparties to the banks.
So when you worry about what's ahead, and it's just almost so ironic to hear we might have a liquidity problem after we were awash in all this liquidity, right?
Yep.
Didn't we flood the system with liquidity?
Yes, and we did, but the system we really flooded with liquidity ended up starting in the banks and moving into the markets. But this is a good fish.
It is a good fish. I'm glad you can talk and fish at the same time. I'm impressed with this.
Ended up in the markets, but we've got most of the market participants don't really have capital requirements. So the banks are very well capitalized going into potentially the end of a cycle, but the non-banks, the shadow banks, really have no capital. Market participants don't really have any excess capital, and that is somewhat of a concern.
And this is what the Fed has been talking about too. I mean, we have heard comments about what are we doing with the shadow banking.
I'm not sure this is a fish, by the way.
Well, whatever it is, it's giving you a workout.
It's a fish. Are you going to talk or fish?
We're going to do both. We're talking and fishing. Wow, nice catch, Josh. That was good. So you're not having any sort of liquidity issue with your catch.
This has been a good day on the lake.
Yeah, clearly. So when we talk about a crisis, are we talking a crisis on par with what we just had in the last financial crisis?
Well, you know, one of my concerns really has been, and it depends. So the liquidity crisis obviously wouldn't be in the well-regulated financial sector, the banks. I do expect that it would be in capital markets players. So that's one piece of it. The last crisis was obviously a credit crisis and ended up as a liquidity crisis. Unfortunately, 4 years ago I would have thought that the next crisis was going to be an interest rate crisis. I think it's entirely likely that it will end up again, because of how long we've kept rates so low, be a credit crisis, different sector. So now I think there's problems in the leveraged loan market, the commercial loan market. It actually looks like the post-dot-com era, where the Fed kept rates low for a long time and ended up keeping companies in business that really otherwise wouldn't have. So if you go back, you think about MCI WorldCom, the low rates ended up keeping them in a viable position where fundamentally they really weren't. So one of the things that I think we need to be watching very closely is commercial spending. because we really haven't seen adequate levels of commercial spending. And that is, to me, one of the drivers that we need to look at. And the other thing that I think that a lot of the economists miss is the senior loan officer survey from the Fed, where credit conditions are loosening. But I think there is some concern about the risks to the system in terms of, again, the leveraged loan market.
Josh, nice catch and nice talking to you.
Wonderful to have you.